All right, so today, I guess lesson we're doing internal to external. So before we get into it, let's define our terms. Internal range liquidity, or IRL. Make this bigger here. IRL will be anything internal to a range. For example, if you have a range like this with a swing high here and a swing low here, anything inside of here is internal, whether or not that's um, a fair value gap or an inefficiency like this, or just a regular candle wick that looks like this. So I'll do a quick example. So if we're looking at, let's say we're looking at something like this, just, oh shit, hold on. But I'm gonna fucking crash out. Okay, here we go. So let's say we're looking at something like this here, right? Inside of this range, assuming this is a swing high and this is a swing low, this high right here is internal to the range we have here. So this right here would be considered your IRL, right? In this case, it's part of this inefficiency right here. Now, it doesn't have to be part of an inefficiency. We could have a wick be something like this, and this high will still be considered internal range liquidity because it's inside of this range. And if we really wanted to get into it, we can assume that we can have an implied fair value gap somewhere in between here, in between the two wicks. That's right here. And this could be our internal to external move, but we won't go too deep into that. But so that is our internal range liquidity. And like I said before, our external range liquidity would be something like just like a swing high like this. Don't mind the candle colors. It'll be a swing high like this. A swing high is where one candle has a lower wick to the left and to the right of it, and same thing vice versa here at the low, where it'll be something like this, and this will be a swing low. And the idea here is that price is going to come back up. In this case, I'll use inefficiency because this is what we're really going to be looking for when we're doing that internal to external, right? Is we want to come into this internal range liquidity right here, and then our external range liquidity target will be right here. Right, so we're assuming price is going to come up into this internal range liquidity right here, and then we're going to come out and take the external range liquidity here. And this is going to be your ERL. Make this a little bit more visible here. And that's the premise of internal range to external range liquidity. And I'll do it right here on a little line graph here. So we'll have a little range, looks like something like this. Price will come in here and we'll take this, and this is going to be your external range liquidity, right? And if we have any like relative equal highs somewhere here, right? We can also use that as a target. But if we're going strictly off internal to external range, the idea is you're going to have your internal range come into, you can have your external range taken, and then price is going to come back into an internal range to take the next external range, and it's just going to continue like that. So we'll look over some live examples of how this is happening. We're going to use this on different time frames so we can zoom in and we can really get a actually good trade on using our internal to external liquidity. Because if we're really just targeting, for example, right here, we're going from external here, sweeping external here, right? We're coming back down to internal liquidity right here. We make this internal liquidity here in the form of this inefficiency. Now we want to come back up into the efficiency. So where's our next external range target? Well, it would be this low right here, right? And if we're looking at this on a lower time frame that's not a daily chart, right, we'll be able to catch a whole move inside of this day and this day candle. So let's come into that lower range real quick. And for this off the daily, I'm going to come into the 1 hour time frame here. And this is the same inefficiency that I marked out right here. This would be our daily inefficiency or our daily CIBI. I'll mark that here. Daily IRL. So this is our daily internal range liquidity. And this will be our daily ERL here, right? And we can see here on the hourly chart, we come into that daily internal range liquidity, and we want to target this daily external range liquidity. So what do we have in here? We have a fair value gap right here, right? And coming over the same exact concept here, we have our external range liquidity swept here, right? We come back down into internal range liquidity here. We see that our internal range liquidity failed here as we have a higher time frame internal to external liquidity here. We can see we have that. We can see we have our fair value gap right here. We can put the stops at the highs and come down and take this low right here. Doesn't look the best, so we can come down and zoom in even more if we wanted to into the 5-minute time frame, right? So that daily goes into the hourly, which goes into the 5, and here's where we can capture that much bigger move. So we can see here we have the daily, then we have our displacement lower, we have our breaker block here on the 5, right? Let me come back into the hourly here, right? And we can mark it our hourly fair value gap right here, right? And the idea is we want to see something happen inside or around this hourly fair value gap here. We have this unicorn model that formed from our internal range liquidity, targeting our external range liquidity here, right? If we wanted to, we can keep zooming down since time is fractal here, and we can put our stop loss at that high right there, and we can target this low. And if we wanted to dig even deeper, right, we could come into the 30-second time frame here and just continue to refine, and we can get better entries with better stop loss management and stuff like that. So we can check out here. So instead of entering at the breaker, because price can go a little bit higher, right, we see that price comes here, right? You can look for any inefficiency that has been created here. Don't really get that good of an entry. You can enter off the inverse of this, but you get the point of that. So we'll go over back to the daily and we'll look for another example of IRL to ERL here. And we can use, let me try to find a good example where we do get to travel a decent distance here. And yeah, we could use this right here. So using this inefficiency right here, right? We want to go from internal, which is we made this internal range liquidity here, right? Assuming we're going to leave this right here as a breakaway gap, right? We want to see this internal liquidity come into what constitutes this as an internal range liquidity. Well, it's because inside of this swing high right here, down to this swing low right here, and then I guess we kind of made another swing low right here, right? And we look at this, this high is internal to this high and this low here. So this will be your internal range liquidity. It just so happens that this high is higher here, right? So we'll use that high in this case. So that would be your internal range liquidity, leaving an inefficiency here. We come into this daily IRL, internal range liquidity here. Then we can jump down into the hourly time frame, but real quickly, we'll mark our external range liquidity here. I'll actually make it ERL. Keep forgetting to do that. We'll make that our ERL, right? And make sure when we're doing this IRL to ERL, you want to be on the correct side of the buy of your market. You want to have your market biased correctly, right? In this case, we managed to shift that structure here to bearish, right? We left that breakaway gap so we know we're in the correct order flow here. We're seeing bearish order flow. We're seeing these bullish PDA races respected. So we can assume that price wants to come internal to external here. And then same thing, vice versa, price goes from external back to internal. And that's kind of the idea we want to see here. So let's jump down into the hourly time frame here. And we'll take a look at what this looks like here on the hourly. All right, same thing here on the hourly, right? We have this daily IRL here. You have your hourly shift and structure here, right? And now you want to look for any hourly inefficiency here to take us down to that ERL, right? And here it is. There's your hourly inefficiency right there. And something like this, and you can take that to the ERL. And that's the whole premise of price. Price is coded in the algorithm to come and attack liquidity, come and find these liquidity points. And what it does is it's going to come into its internal range liquidity here. And we can see that it does the same exact thing here. It doesn't have to be on the daily. We can see that we came up out here, and this is your external range liquidity here, right? We came out. Now we have to return back to internal range liquidity. We can see we're failing to return to internal range liquidity here, right? If you wanted to run your standard deviations from this mitigation block, you can. But in that case, since we failed, right, we want to come back into internal range liquidity to target that external range liquidity, which in this case would be this low here on the hourly, right? From this low, if we wanted to, we can come down into the 5-minute here and we can see the exact same setup play out. Just find it here, right? Off of this hourly, right? If we want to come down and take this 5, right? You want to ideally see a 5-minute setup here. Unfortunately, I think given to the time, there was no 5-minute setup, but we can see how price comes into here and drops down just like that. Now, do we have any questions about internal or external liquidity? So order blocks are generally internal liquidity. Well, if you think about this, let me do this. Order blocks are you're not really sweeping liquidity in the case of an order block. Like if we look at this order block here that was formed, right? There's no real liquidity that has been swept here. So you really want to look for inefficiency, or you want to look for a liquidity or any kind of swing here to for liquidity to be swept before going lower. After hitting internal, looking for lower prices to external, what do you think in terms of signs of us not reaching external and going deeper into internal? You really want to look for order flow if that's the case. Like here, we can tell that we left this breakaway gap here, right? So we can assume that if we're leaving this as a breakaway gap, we can see this IRL come into and pushed into this ERL here, taking out here. And now here we could assume the same thing, right? That we took out this ERL, right? We made these relative equal lows here, and then we're coming back up into the IRL. Unfortunately, this just gets violated, and I honestly have no answer for this one exactly getting violated, except for price wanting to push higher. But let's come into a lower time frame, so maybe I can show you guys a better example of when price is not going to go deeper. And my real like answer to that be is really when we take out that liquidity point, when we reach a standard deviation where or we come into a higher time frame period, right? That's telling us, we wanna it's time to go higher, it's time to go lower. So actually let me do this real quick. Come into daily real quick. Fuck. It's not even Let me come into daily real quick because I think we had a really good example on this day right here where we were pushing higher because we can assume, right? We're pushing higher off of this discounted daily here, right? This discounted daily part of the SIBI here. So I'll draw this out as well. I mean, BISI here, right? And we're kind of stuck between, are we going to go from IRL here to ERL up here? Or are we going to go from IRL here down to the ERL here? And this is kind of where we can kind of make an assumptions here. And then now this is when we can come down into the hourly time frame here. And we can see, well, what is order flow telling us here on the hourly? Well, order flow on the hourly is here is telling us bearish. So this is where we can kind of figure out, okay, yeah, look, we have these relative equal lows here, right? So this is not where we're going to see price fail to do its IRL to ERL if we're going down lower, right? Because this is how we have more liquidity here than we have liquidity up here, right? We come into this daily when this bearish order flow here, so we can assume we come down here. And now here, right, when can we assume that this IRL, right, this IRL here is going to fail, right? Because we can see this fail. Well, we come here and we can see we took out a major pool of liquidity right here, right? So we took out pretty much all of the low resistance liquidity that was here, right? We can even choose this liquidity down here if we really wanted to. And so we can see that we took out our probably drawn liquidity, right? And that is why we saw that IRL fail. Does that answer your question there? Once we see this drawn liquidity fail here, for like this, like if we're looking at this, right? Because your IRL to ERL is here, and eventually you're going to see your drawn liquidity here is going to get hit somewhere here. And then this is what's going to cause the IRL to ERL to fail here. So if your drawn liquidity was here, assuming this was your ERL target up here, right? But this was already your OC or whatever drawn liquidity you had here, right? Once market takes this, it might have switched to bearish order flow now, right? We might have switched from the buy algorithm here, took out this liquidity. Now we're going to seek this liquidity here in the sell algorithm. So this is when you can expect that internal range liquidity to fail once we reach the objective that we were planning to go to already. Does that make sense? Yeah. And this is applicable for Forex, yes. Um, Do you use internal being swept similar to an SMT being formed in terms of a sort of confluence for your trade, or is that just a mental note? Well, if we're looking at internal being swept, it's really just going into an inefficiency. So I'm just looking for price to overall come into an inefficiency because if we're looking at this hourly time frame here, we're sweeping external here, but we're going into the daily here, right? What are we really doing? We're shit, I just fucking switched pairs, bro. What the fuck? Okay. Here, right? We're coming back into this inefficiency here. So I don't really use price coming and sweeping internal range liquidity that much because 99% of the times is just going into an inefficiency or BISI SIBI. And that's what I'm really looking for to see how and what we're going to do off this BISI and SIBI. Does that make sense? All right. Do we have any more questions here? Do we want to see another example? Do we want to see a Forex example? Or do we have any questions? Any more questions do we have? If not, then we can do a wrap up here. Yeah, we can do a Forex example. Yeah, let's come into here and we'll look at, I think gold had a really good one here. Yep, gold did have a really good one here. Or the yen also had a pretty good one. Yeah, I guess we'll do the yen here because now we can kind of show off this here. Yeah. So assuming right here on the weekly time frame here, we swept this liquidity here, right? And this was your internal here, internal to external range here, right? And this seemed to be where the market's strong liquidity was for some reason, right? This was the all-time highs, right? We did that, right? We shifted our structure. We can talk about it now if we want to, or we can save it for another stream, whatever RLE wants to do, then I'll just follow whatever he says here. But while Arlie types that out, right, we can see we went from our internal to external here, right? So, and we can tell we shifted our structure here. Actually, your structure shift point will be here, right? So now we can look for that bearish internal to external range liquidity right here, right? We have a really nice target right here. And we can see price comes into this right here, makes this relative equal low, and then we can consider this our IRL target here, ERL target, sorry. Relative equal lows or your ERL target here. Right, this would be your ERL here because this is your swing low that was created inside of this range. Your internal range liquidity here would be this. So this would be your IRL here. Right, so we're going to come into this inefficiency right here and we're going to expand down to that ERL there, right? And to get a better entry, you do come into your 4-hour here, right? We can see we shifted that 4-hour structure. You have your 4-hour breaker right here, right? And you can enter that off your 4-hour breaker, right? And I guess I already did say we could have a little demo of your standard deviations here. So we can draw out our standard deviations from the swing low that made your breaker block to the swing high that made the breaker block. Draw your standard deviations, and I'll do the limited because we're not going to go too far into it. And here is your 2 range, 2 to 2.5 range on your standard deviations here. And this is where once price comes into here, we're going to see how heavy price is going to be to um, come into it here. So this is usually a rejection point for coming into here. And you want to see this zone here line up with the pool on liquidity. And that tells you most likely your draw on liquidity is going to be correct here. So we have this 2 to 2.5 zone here. And this is where you're going to want to see a reversal generally happen. And you want to see the strength of how much we're going to reverse here. So if we draw a range from this high down to this low, actually it'll be this high down up to here. All right, it'll be the swing low that came into the 2 to 2.5 range here, the swing high, mark out equilibrium, and this is what's going to tell you your strength. So once we reach this 2 to 2.5 area, if price wants to stay bearish, we can come up to equilibrium, and we have to reject around equilibrium, maybe come up a little bit higher into a more premium inefficiency here before continuing lower down to that 4 standard deviations, right? However, if we do come back up here and completely reject equilibrium here, that means that chances are we're not seeing this 4 standard deviation complete. Now, what can we also see? We also don't have to see price come up into equilibrium, and same thing, the same concept kind of applies with the fair value gap. If you're going to take its quarters, here, let me not do that one, let me do this one here. If you're going to take its quarters here, right, the idea here is when if you want to see bearish prices here, right, you want to see price stay under that 50% here, right? But that doesn't mean price cannot come up into equilibrium or consequent in the case of fair value gap, consequent encroachment, and a little bit higher before continuing lower, right? This just tells you the relative strength of exactly what price is doing. So we can see here, let's draw quarters. I'll clear this out, right? After coming into this 2 to 2.5 here, look at where we're rejecting right here. We're rejecting this first quartile of this range here. So that means we're showing strength and not coming back up into equilibrium. Once again, we don't have to come up here. This is just as far as we can get before we have to either determine, okay, we're no longer going for this 4th standard deviation or any liquidity lower. And now we could be looking for buys here, right? We can see we're rejecting this quarter part of here right here. And what does this tell us if we're going to reject this? That prices really want to hunt for this relative equal low here, and that's what we can assume here. And maybe once price takes out this, we can continue to draw our quarters from here, right? And then this is going to tell us our next standard deviation, and it's going to tell us if we're good to come back up to equilibrium or we're going to continue to fall to that 4 standard deviation. So that's a brief description of your standard deviations. You also have your time standard deviations. That would be that's not really talked about, but that's another form of standard deviations for you guys to understand exactly when certain things happens in the concept of time. But we'll go over that probably some other time. So do we have any more questions here about this ERL to IRL situation here? And if you guys have any questions, type it in chat. There is another ERL to IRL thing right here, right? We're looking at it, right? We come up, shift structure right here. It's your IRL here, ERL here. Down. Yes. Everything is fractal. Time is fractal. That just means everything you see on a higher time frame will also be there in a lower time frame. Does that make sense? What do you mean by example, Matt? Example of like a lower time frame, internal to external? Yeah, we can do that. We can do the 5-minute here, back on NQ. Yeah, okay. So one thing I will say is that I would not be looking for I would not be looking for IRL down to ERL on anything less than a 5-minute time frame. If you have the 30-second time frame available. Now, if you do not have the 30-second time frame available, your next best bet is IRL to ERL. You want to see that on the 15-minute time frame. Nothing less than this. Because with this, you're going to go down to the 1-minute time frame, right? And that's when you can catch your IRL to ERL move. Because realistically, if we're trying to catch a 5-minute IRL to ERL, it's not going to be that much here, right? It's going to be like, let me see if I can get a good example here. Right, I guess you can use right here, right? It's not going to be that much. Right, you have this here, right? And you have potential for like your risk to reward isn't going to be great coming into here if you're going strictly just off the 5-minute and we're not coming down here into the 30-second to really look for that model to find these relative equal highs that's located right here for that 30-second model and for the 30-second ERL, because then your stop loss has to account for this whole fair value gap because price can still come down into it, possibly this wick here if price wants a wick down and fill this completely and possibly even this fair value gap here. So that leaves you a lot of open room here compared to, right, if we are able to come from that IRL. And we're assuming that we want this IRL to ERL here because we shifted the structure right here, right? Then this is where we can see, okay, we can come down into like a 30-second time frame here. And this is where we can look for, what the fuck? Okay, well, I just broke the fuck out of this shit. Hold on. Okay, well, that shit just broke the shit. Anyways, where was that 5 minute? Um, okay, that 5 minute fucking vanished. So we'll find another one. We'll find another one that's closer to here that doesn't fucking break trading view. Um, let's see if it's a good one here. Yeah, we could look at this 5 minute internal to external here, right? If this is going to be your URL here, right? And we're assuming this fair value gap is going to be your IRL here, right? It makes it hard to take it directly off of the 5 minute because if we want to do come into this and just take it off of here, your risk to reward is going to be really bad, right? And that's kind of the idea of this ERL to IRL thing here. But if we do drop down here onto like a lower time frame, like a 30-second here, and we look at that same one right here, you can probably get a better model here, right? We come into the 5, dig into the 5 here, every 30-second BISI here, right? And this is where you can get, right, your IRL to ERL here on that 30-second, which does give you the 1 to 2, which is much better than this 5 minute right here. But if you don't have that 30-second, then I would suggest a 15 minute right there to kind of just continue, right? Like we can do the same exact thing here, right? This IRL would be here. Your ERL would just be right here, which is not that much here, right? And if we want to enter off this basing, we'd have to cover that, right? Still a possibility price could come into this 15 minutes. Doesn't make sense. And this just doesn't really make sense to risk to reward, but we want to come down into that 1 minute to capture that IRL to ERL move. And the 15 minute also shit disappeared. Oh no, it's right here. Okay, cool. Right, I'll make much more sense to capture this fair value gap right here, right? This fair value gap right here stops above this high, stops above here, something like this, targeting this, and that's where you get your much better risk to reward ratio coming into your IRL to ERL. Does that make sense, Matt? Okay, cool. Do we have any other questions here? Not, then we can wrap this up.
That was
I bet.
beautiful,
Welcome to the
Zach.
stage, Arlie.
That was beautiful. Um, if you guys have any more questions regards to what concepts you guys want to be taught throughout next week, definitely let us know. Not in the comments. Well, actually, in the comments as well. Yeah, for the YouTube jets. The comments and let us know in general chat. Definitely DM Jamie. But that was internal and external range liquidity covered by Exotic. And until next time, deuces.